Hi guys, welcome back to my channel. Kelvin here. Every month, we are forced, willingly contribute 20% of our pay to CPF, where it gathers interest and does for many years. However, the thing is, our CPF OA money is just sitting there earning a super duper low 2.5% interest. So, in this video, I will share 3 ways as to how you can invest your CPF OA money to get a much higher return. Because after all, if the money is going to sit there for 30 to 40 years doing nothing, it's a good idea to invest that money so that you can get a much higher return on them. But before I start, I would greatly appreciate it if you can help to tap the like button and subscribe if you haven't done so. In return, I will show you a cute cat. Alright, let's start right now. Okay, the first method is to transfer money from OA to SA. Because while OA gives 2.5% interest, SA gives a slightly higher interest at 4%. Now, don't underestimate this extra 1.5% interest because of power of compounding. Check this out. If we have 10k in CPF OA and SA, after 40 years, the money in CPF OA will grow to around 26.8k. But CPF SA will have 48k, almost twice the amount, just because of the extra 1.5% interest. So, if you want a risk-free way to grow your CPF money, just transfer it to CPF SA. But with that being said, here's one very important thing to note, and that is this transfer is irreversible. Meaning, once you transfer over from OA to SA, you cannot go down anymore. So, only do this if you are very sure that you don't need CPF OA for anything else, yeah? Okay, with that being said, even though this is a good risk-free method to grow your CPF money, I wouldn't recommend young adults to do this. This method is only good for folks who are in their 50s or 60s and don't have that many years to grow their money. Check this out. When your investing period is short, you will have a higher chance of losing money. Now, of course, past data does not guarantee future performance. But in general, if you hold a good investment over the long term, you are more likely to make money because stonks. So if you are in your 20s to 40s, you have a long time horizon to invest your money. Hence, transferring CPF OA to SA may not give you the best returns. But if you are in your 50s or 60s, your investing horizon is quite short. Because of that, transferring CPF OA to SA may be a better way to grow your money. Moving on, the second way to invest your CPF money is through a robo-advisor. Currently, there's only 2 robo-advisors that lets you invest your CPF money, and that is Endowus and Money Owl. For both robo-advisors, you can choose different risk levels. For example, on Endowus, there's 6 different risk levels that you can go for. If you want to be super safe, you can go for 100% bonds, which will give you the lowest return. Or if you want high risk, high reward, you can go for 100% equities. Same for Money Owl, which has 3 different risk levels. But with that being said, I feel that there's no point going for low risk portfolios because their returns will be CPF low. If you want to be safe, then you might as well transfer your CPF OA to SA and earn a 4% risk-free return. Unless Singapore kena invaded, then that's one different story. So if you have a long investment horizon, it's best to go for 100% equities, which can give you a higher return over the long term. Quick pause. Webull is the latest stockbroker in Singapore. With Webull, you can now buy US stocks, US options and Hong Kong stocks for a low fee of $0. Yes, that's right. It's zero commission trading. Webull also supports fractional shares. So you can now buy stocks with just your $100 Angbao money. But the most important question is, what's their sign-up gift? If you sign up now, deposit at least $1,965, make 6 buy trades on either US stocks, ETFs or options, you will get $100 worth of free Google shares. This promotion ends on 1st September, yeah? So if you are interested, you can sign up with my link down below. With that being said, let's get back to the video. Here's an issue. If you check Money Owl's highest risk portfolio, it is only investing in one fund, the Lion Global Infinity Global Fund. So essentially, you are investing through a robo-advisor, but you won't get all the benefits of a robo-advisor, like fund management and auto rebalancing, because there's nothing to manage when there's only one fund. Because of that, I wouldn't consider Money Owl's highest risk portfolio as a true robo-advisor. So I will only look at Endowus for this method. For the holdings, it has 40% in S&P 500 companies, 30% in companies from developed market, 15% in Asian dividend-paying companies, and 15% in emerging markets like China, South Korea, Taiwan, and so on. On average, this portfolio gave about 9.92% 10 years annualized return. As for the fees, there are actually two fees here. The first fee is Endowus management fee, which is 0.4% per annum. And the second fee is fund level fee. The fee ranges from 0.34% all the way to 1.22% after cashback. When you add up both fees, you will be paying between 0.74% to 1.62% per annum. So that's investing through a robo-advisor. The benefit of doing so is that it will manage your portfolio for you. All you need to do is just shut up and take my money, and it will do the rest. Like help you rebalance the portfolio to maintain the portfolio optimization, or if there are better funds out there, they will let you know. So you don't have to worry about your investments. You can just sit back, relax, and play your cat game. Oh yeah, just to set some expectations here, just because a robo-advisor is managing your portfolio doesn't mean that you will never get negative returns, yeah? That's impossible. I got someone saying that he lost money because he invested in Endowus. That is totally normal because the market has also dropped during the same period. So just ignore short-term fluctuations, invest over the long term, and you'll be alright. Because stonks. Oh yeah, by the way, if you want to sign up to Endowus, you can sign up using my link down below and get $20 in access fee credit, yeah? Moving on, the third way is to invest in ETFs. Just in case you don't know, ETF is basically a basket of stocks, like a basket of US stocks or a basket of Singapore stocks. And because an ETF has a lot of stocks in it, you will get diversification. So even if one company does badly, you won't suddenly lose all your CPF money. That would be counterproductive. The other benefit is that ETF is self-cleansing, meaning if the company is doing badly, the ETF will kick out the company and replace it with a better one. So you will always end up with the best companies. Now, if you check the list of CPF approved ETFs, there's only 6 of them. And personally, I don't like any of them because all of them don't have much growth potential. For example, ABF Singapore Bond Fund and Nikko M Corporate Bond Fund invest in bonds, which has very low returns. Then Nikko M STI ETF and Spider Straits Times ETF don't have much growth either. Nikko M Straits Times Asia X Japan REIT ETF focuses on dividend, which also doesn't have much growth. And finally, Spider Gold Shares invest in gold, which can't give you high returns over the long term. So I wouldn't recommend investing in these ETFs. Then how like that? Luckily, there's a way to invest in ETFs, and that is by using Endowus Fund Smart Portfolio. If you go to Endowus Fund List, filtered by CPF OA, you will get about 30 plus results. Then, to get the highest return, filtered by equities, and you will be left with 20 plus results. Whichever you choose is totally up to you. But my personal preference is to invest in developed markets because they are already well established. Once you apply that filter, you will be left with 2 choices, which are actually both the same thing. Lion Global Infinity Global Fund. So just go for the one with the C class because the expense ratio is lower. This fund is still new, so you can't see the long-term return yet. But if you check the other fund without the C class, this fund gave about 8% 5 years annualized return. This fund invests in companies from developed countries around the world. You have top companies like Apple, Microsoft, Amazon, Google, and Tesla. If you look at the geographical breakdown, 67% of the holdings are from US, and the rest are spread across other developed countries. As for the fees, there's a 0.4% Endowus management fee and a 0.34% fund level fee. So that's a total of 0.74% fees. By the way, you may remember that Money Owl highest risk portfolio is also investing in the exact same fund. So if you are just investing in this fund, then you can consider Money Owl here. If you check Money Owl's fees, the fund level fee is 0.42%, while the management fee is currently 0%. But this is just a promotion rate which will last till 31st December 2022. After that, it will go up to 0.4%. So during the promotion period, money out is cheaper than endowers. Then when the promotion ends, money out ends up becoming more expensive. Because of that, I would recommend to invest with endowers to save on fees over the long term. Okay, let's summarize this. Among the three methods, my favorite is by investing in Lion Global Infinity Global Fund through endowers. Here's why. First, it is investing in companies from developed countries around the world. So the risk is much lower, but you will still get a decent growth. And second, the fees is actually quite low. So I will end up saving on fees. Anyway, those are the three ways to invest your CPF money. But what other ways do you know of? Do comment down below and let me know. Like, share and subscribe as I'll be posting new videos every Monday, Wednesday and Friday. Bye!